Have you ever pondered why free cash flow is a crucial indicator of a company's financial health? It might sound like a mouthful, but it's actually quite simple. Free cash flow is the cash a company is able to generate after spending the money required to maintain or expand its asset base. Think of it as the lifeblood of a company, the financial fuel that allows it to grow, invest, and provide returns to shareholders. It's an often overlooked figure in financial analysis, but it's incredibly important. Why, you ask? Because it represents the company's financial flexibility. With a robust free cash flow, a company can pursue opportunities that enhance shareholder value. It can invest in new projects, acquire other businesses, pay dividends to shareholders, or reduce debt. In essence, a strong free cash flow signals a company's ability to generate value even after taking care of its basic operational costs and capital expenditures. It's the financial prowess that allows a company to weather economic downturns, invest for the future, and return capital to shareholders. So, a company with strong free cash flow is like a well-oiled machine, ready to conquer any financial hurdle. One such company is Visa. Visa, the global payment technology company, has recently reported impressive operating results for its fiscal fourth quarter of 2023. The numbers tell a tale of a business that is not just surviving, but thriving in a highly competitive marketplace. Let's delve a little deeper into these figures. Visa's net revenue grew by a notable 10.6% to $8.6 billion, outpacing analyst expectations. This growth has been underpinned by steady consumer spending and an uptick in cross-border transactions. It's a clear indicator of the company's strong position in the global payments ecosystem. But that's not all. Visa's payments volume saw an increase of 9%. This might seem like just a number, but it represents billions of transactions made by consumers around the world, a testament to the trust and reliability that Visa commands in the payments industry. Processed transactions, another key performance metric, also grew by 10%. This growth is driven by Visa's expanding card base, which now reaches across borders and continents. The more transactions Visa processes, the more revenue it generates, creating a positive cycle of growth. Let's talk earnings. Visa's non-GB app earnings per share surged by a whopping 20.7% to $2.33. This growth was fueled by higher net revenue and an improved net margin. Earnings per share is a key indicator of a company's profitability, and this surge demonstrates Visa's ability to generate profits and deliver value to its shareholders. And what about the balance sheet? Visa's balance sheet remains strong, with a net debt of just $335 million against $22 billion in EBITDA. This low level of debt, coupled with high earnings, is a sign of the company's financial health and resilience. Visa's solid financials are a testament to its strength in the market, but what makes it even more attractive? Its robust free cash flow generation. Visa's financial health is further bolstered by its impressive free cash flow generation. This isn't just a statement, it's a reality that can be seen in the company's robust balance sheet. With a net debt of a mere $335 million, Visa stands against a towering $22 billion in EBITDA. This disproportion in favor of the company's earnings is a testament to its financial strength. Free cash flow, as you may know, is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's a vital indicator of a company's financial health, and in Visa's case, it's a sign of a thriving business. And Visa isn't just sitting on its free cash flow. The company is using this financial power to reward its shareholders. A recent announcement revealed a 15.6% increase in its quarterly dividend per share. This means more earnings for shareholders, reflecting Visa's commitment to sharing its success. But the good news doesn't stop there. Visa also launched a new $25 billion share repurchase program. Share repurchase programs are a strong sign of a company's confidence in its future growth. They reduce the number of shares on the market, which can lead to an increase in share price and provide a return to shareholders. In essence, Visa's strong free cash flow generation is fueling its growth and rewarding its shareholders. It's a cycle of success that is hard to ignore for anyone looking for a solid investment. Visa's free cash flow generation not only highlights its financial stability, but also makes it an attractive investment option. To sum it all up, Visa's strong financial performance, coupled with its robust free cash flow generation, makes it a compelling investment. Let's take a moment to revisit the highlights. Visa's net revenue grew by 10.6% in the fiscal fourth quarter of 2023, surpassing analyst expectations. This growth was supported by a 9% increase in payments volume and a 10% rise in processed transactions. The company's non-GAAP EPS surged by a notable 20.7% thanks to higher net revenue and improved net margins. Visa also announced a 15.6% increase in its quarterly dividend per share and a fresh $25 billion share repurchase program. Visa's valuation is in line with its historical average, suggesting its stock is reasonably priced. And with Berkshire Hathaway owning a $2 billion stake in Visa, the company's profitability and growth prospects are underlined. With all these factors in mind, it's clear that Visa's long-term returns are expected to outperform the S&P. So the next time you're pondering about stock market investments, remember this. A company's free cash flow can be a reliable compass guiding you towards profitable shores. And right now, that compass is pointing towards Visa.